Hi everyone, welcome to today's webinar. This webinar is being brought to you by the State Federal RPS Collaborative. This project is managed by the Clean Energy States Alliance, also known as CESA. And to begin with, I'd like to go over a few quick housekeeping notes. All of our participants today are in listen-only mode. If you would like to listen in using your computer, mic, and speakers, you can follow the instructions on your screen. This option allows you to avoid the telephone toll charges that you would earn if you connect the audio using your telephone, but both are perfectly good options. One important note is that we would like to encourage everyone to please submit your questions at any time throughout the broadcast today by typing them into the question box in your webinar console and hitting send. We will be reading through the questions throughout the webinar, and we will queue them up and answer them at the end of the broadcast as time allows. So again, type your questions in as you think of them. Don't wait till the end. And my final note is that this webinar is being recorded. You will find a recording as well as slides of this webinar available on our website later today at cesa.org/webinars. And with that, I would like to pass this over to Warren Leon. Warren is the Executive Director of CESA, and he manages the State Federal RPS Collaborative. Warren, please go ahead.
Thank you very much, Samantha. This is going to be a very good webinar today. I first want to tell you about CESA if you're not familiar with us. We're a national nonprofit organization that works to implement smart clean energy policies and programs across the country, especially at the state level. And at the core of our organization is a national network of public agencies that are individually and collectively working to advance clean energy. If you could go to the next slide. One of the things we do is to manage the State Federal RPS Collaborative. It's funded generously by the Energy Foundation and the U.S. Department of Energy. And this is an information sharing and networking activity for state RPS administrators, federal agency representatives, other stakeholders. We do a lot to advance dialogue and learning about RPS program best practices. We have a monthly newsletter. We do webinars. We have an annual summit. You can sign up for any of these things. We won't flood your mailbox with announcements, but you will learn about what's going on in the wonderful world of RPS. You can go to our website, www.cesa.org, to learn more about the RPS Collaborative. If we can go to the next slide. Very simple. I'm going to introduce today's speaker, Lars Kvaal. Lars manages APX's environmental markets team. APX plays a very important role with a large number of renewable energy and carbon registries across the country and with renewable energy tracking systems. That includes MIREX, MRETS, North Carolina RETS, NEPL GIS, Regis, the North American Renewable Registry, and several carbon registries. Prior to working for APX, Lars Kvaal worked with the Center for Resource Solutions to develop standards for Green E, and he also has experience working with the California Energy Commission and various renewable portfolio standards. He's been an active participant in the RPS Collaborative, often giving us good advice and speaking at our events when he has valuable expertise to offer, which is often. When I learned that APX Environmental Markets had written a paper on the topic of using tracking systems with the implementation of Section 111D state plans, I rushed out and read it, and it's very good, and I thought it would be useful for us to have a webinar for Lars to give you an overview of the types of things that he and his colleagues wrote about in that paper. So with that, let me turn it over to Lars, who will give us some information on this timely topic.
Thank you very much, Warren, and thank you to CESA for allowing us to speak about this as well as for the multitude of events you run throughout the year that I think help educate everybody about RPS and related issues. With that, I will start by kind of outlining what I will be speaking about today. And there we go. We'll focus a little bit on background, just a bit about renewable portfolio standards, registries, RECs, a little bit about how those markets works now, and then delve into Section 111D and how that looks at renewable attributes, energy efficiency. Focus a little bit on some of the existing registry elements that can support various Section 111D implementation options. Outline some of those options, and I think this may be the most interesting part, or the reason Warren really wanted us to speak, is that we kind of try to step out and say, well, what if states do this? How would the market look like? And I should note that this is not an attempt to try and say that this is what states should do or shouldn't do, as much as just a way of describing if this implementation option is chosen, and this is an implementation option that fits within the general rules of Section 111D, then this is how it could be handled in the marketplace on how the interaction between different policy instruments, as well as how the market infrastructure such as registries would look. We're really looking at this, and both in the presentation today and the paper we wrote, from the practitioner viewpoint. So if this goes forward and this has to happen, how would programs and infrastructure be structured? I'm not going to weigh in on any of the legal discussions about what can or cannot be done from a legal viewpoint, and I'm not going to make any kind of second guessing or future guessing about where this program may go, and nor is trying to say this is the best policy, this is the worst policy. So with that, we will in the end kind of conclude and have a couple more questions, but that's essentially the program for today. And if we just take a quick look at the lay of the land as registries are currently constructed, these are the various registries that operate for renewable energy certificates, renewable energy credits in North America. I should say that there's a red one, NYSERDA, on there for New York, that's in the planning stages, but all the other ones are certainly up and operating. The earliest one from 2001 in Texas, and since then several other ones have been added, so they now cover the entirety of the country. A couple things to note is that within the last couple of years, and after the map kind of filled in with various tracking systems, the ability to import and export across various tracking systems has been developed, and more registries now allow for both imports and exports in support of the various RPS markets. The primary driver between, the driver for the need for imports and exports has been renewable portfolio standards that may allow sourcing from a wider region than not just the state or local region or neighboring states, but also further away, and in some cases even nationally. The boundaries, as you can see from the map, obviously vary, with some of them following state lines, and some of them following power pool lines, and some of them following other maybe more randomly looking lines, and that is something that's characteristic of the tracking systems, how they're set up, as well as for the power pools, and has some implications for 111D. Some tracking systems track all attributes. That's NEPOL GIS and PJM GATS. We'll return to this a little bit, but basically in those systems, every megawatt hour of power is assigned an attribute, whether it's a coal certificate, natural gas certificate, or renewable certificate, and then that is followed along to support attribute programs where, as an example, states will require power disclosure to be made by utilities of where they got their source their power from. In addition to those systems also supporting renewable portfolio standards. Finally, a couple of the systems, including NEPOL GIS and North Carolina and North American Renewables Registry, or NAR, also support the issuance of certificates for energy efficiency, something that may be more in need for as a result of Section 111D. As mentioned, some of the boundaries for tracking systems follow power pool boundaries, such as PJM GATS and the planned New York system, as well as NEPOL and ERCOT. Others have various elements of different ISOs or RTOs within their territory, but may cover a larger or a smaller area than that. I think the main thing to take from this map, and this is a bit outdated, I believe, but the main thing to take from this is the complexity between the Section 111D rules being written principally for states to implement programs, and obviously power markets not following state markets or state boundaries. So taking a step back and looking a little bit about how the market looks today for renewable energy certificates or RECs, essentially what happens is that the product of renewable energy is unbundled. So you'll have energy going in one direction, and then you'll have renewable energy certificates or RECs in another direction. And the energy then considered a null power will be sold into power markets under various structures, or while the attributes of that renewable energy power follows a REC. That REC is what's tracked in the tracking system and is then eventually used for either a renewable portfolio standard market or a voluntary market. I believe the current share is somewhere between 2/3 of the RECs go to the renewable portfolio standards and about 1/3 to the voluntary markets. But both of those are very large markets that have been in existence for a long time. The definition of a REC does vary a bit from state to state, and in some cases from tracking system to tracking system. In general, though, they are considered to include the carbon benefit, although it's not necessarily more defined than the carbon benefit in terms of there's not always or generally a number assigned to it. Other pollutants generally are not emphasized as much. Certainly some of the ones that are covered on the acid rain cap and trade program are not considered to be part of a REC. And then there's the question, what are the other benefits associated with a REC that sometimes comes up. I think the main thing to take out from this graph, and we'll return to this one a couple of times, is the energy that does not have a REC associated with it is considered null power. The concept of null power is mentioned in some of the guidance documents associated with 111D. I know it's a subject that CISA has thought about looking into as well. But the idea is that if you get wind power from a wind facility, but you don't own the REC has been sold to somebody else, you can no longer claim that as being renewable, and nor necessarily can you claim that it's a power with no emissions. It's really null power or system power. And again, I'll get back to what that means in terms of Section 111D. Just a quick overview of the Clean Air Act, and I'm by no means the expert on this or the legislative history, but it goes way back. It goes back to a law passed and signed by Nixon. It was in 1990 the background for instituting the first real cap and trade program, the acid rain cap and trade program, which was generally just to be a success. More recently, it was then used to create emissions performance standards for new power plants in the United States. And the last part of this is then Section 111D, where the EPA in June of this year issued their draft rules for how to set performance guidelines for existing power plants. There's a calendar that they have that the EPA is striving to stick to, and actually emphasizing they will stick to. The next step of that is there will be a final rule issued next summer. That will then lead to the states having to undergo their process to define their state programs and implementation plans. And they'll have 1 or 2 years to do that, depending on how they choose to go forward. The proposal itself, it's to regulate the greenhouse gas emissions from emitting generating units, fossil fuel units. It does not go in and say each power plant or each EU has to emit a certain level or go get below emissions of a certain level. Instead, it says specific targets for each state to implement, and those targets do vary from state to state. The target of the rule is to achieve 30% emission reduction compared to 2005, and that is the expected reduction if the states comply with the emissions intensity target. And that is a key point here, is that the targets that have been set by the EPA are intensity targets, or rather pounds by megawatt hour. The way that states are looked at, or the options that the EPA outlined and put into their modeling of how states could achieve this reduction, rests on 4 building blocks. One around plant efficiency improvements, primarily coal plant efficiency improvements. The second about the redispatch from more emitting units to existing natural gas combined cycle power plants. And then the two that we'll focus on today are specifically the third one, which is additional renewable energy generation, and finally demand side energy efficiency. I should note in this presentation, I'm generally talking about renewable energy, and I'm talking about RECs. However, most of the conclusions in here would be the same if we were talking about energy efficiency certificates instead, or EECs. The focus is RECs today, but just so you know, the same kind of general principles apply. States will choose whether they want to utilize a rate-based or mass-based target, although there's a lot of questions in the comments that we just submitted to EPA about exactly what that means and how you convert between the two. What if one state chooses one option, mass-based, and another state chooses rate-based? And this very issue might actually be something we look into a little bit further at APX as well. So if we take a look at the state's targets that were set by the EPA, and I think the appropriate credits for this graph is not APX, but they're included on the slide, you'll see that the targets vary very much across different states. Specifically, if you look at the 2030 target, the percentage reduction, some states are 11%, and other states it's more than 50% that has to be reduced compared to the baseline that's been calculated. There is an interim goal in 2020, but again, this graph is, and the following map is really just to show that there's a large variance between the targets that different states have to meet. This generated a lot of focus in the comments that have been submitted based on how the modeling was done, and in general, I'll not get into too many of those issues, except to the extent that they actually, in some cases, impact conclusions. And the way that EPA set the baseline has some impacts on what are the potential tools that can be used to reduce emissions. So, getting into the more specifics of Section 111D and what EPA wrote as it relates to the REC markets and renewable portfolio standards, they do spend a significant amount of time outlining how REC markets work today and how they should be accounted for in Section 111D, including the idea that the states that purchased RECs, even if the generation took place in another state, they should be able to claim the benefit from those RECs, the emissions benefits in the eyes of Section 111D. That leads to essentially, you can claim the emission reductions from that renewable energy, regardless of where the location was, as long as you have ownership of that certificate, of that attribute for that power. The question then is, how can you account for this when you have power markets that span several states? What if neighboring states choose different implementation options? How about the emission liabilities from emitting resources exporting power? So as an example, when you have a coal plant that exports power to another state, who should account for the emissions from that coal plant? The ones buying the power and using it, or the state that's generating it? And generally, it looks like EPA is leaning towards that should be accounted for in the state where the emissions take place. So for emitting resources, the same principle about owning who owns the attribute, in this case the liability of the power plant, does not count is not the same as it is for RECs. So that's one of the interesting kind of dynamics and conflicts within the 111D rules. Finally, not all RECs are created equal. What I mean by that is that Section 111D is focused on the emissions from a power plant. Not all RECs come from resources that have zero emissions. Well, that has to do with taking into account some of the upstream or biogenic emissions footprint around biomass. Well, it has to do with the fact that certain renewable portfolio standards give certain classes of RECs to facilities that otherwise claim that otherwise they still have some emissions. So the short of it is, for this presentation, when I talk about RECs, we're talking about RECs from facilities that are considered to not having any emissions from carbon dioxide emissions. So looking a bit about some of the current elements that are in registries and how they could help support 111D. If we start at the top, obviously registries can track emission attributes for every megawatt hour generated. This already happens for the systems in PJM gas and NEPOL GIS. This could support the allocation of emission liabilities for purchased power. So you could have an approach, and we'll dive into this a little bit later, where basically utilities, based on the certificates they have, will have a certain emissions footprint, basically the average rate of emissions across all the different certificates they have, and then that is, what would have to be matched up with some kind of tool to balance out those emissions, whether that's through buying allowances or buying racks or so forth, and we'll get to the practicalities of that in a bit. Again, the point is that the registries, certain registries already do this today, and it wouldn't be a large step to add this functionality to registries that don't support this today. Having that in both NEPO and PJM gas as well, in those systems, if you have certificates that are not claimed by anybody, so often this would be coal certificates or other certificates that are not demanded for one reason or another, then the tracking system automatically calculates a residual system emission rate. So to the extent you have a utility that had megawatt-hour sales and they did not have a certificate to match up with that, they would get a residual mix certificate, and that would essentially have the average emissions of the pool that was not claimed. And that way the system works and all emissions are accounted for. The tracking systems also calculate what the average emission rates were for the certificates that were issued and retired in a given year. As mentioned, several of the tracking systems also have the ability to track energy efficiency savings. Often the key task here is how do you do, what's the verification process and the methodologies used, but that certainly is something that tracking systems do today. There is the potential within the EPA rules to have an emissions credit, essentially the emission reductions associated with renewable energy and energy efficiency, used to potentially comply with the targets. If that is implemented, there are ways, in North American Renewables Registry did this as well, where you can track what is the emissions reduction that was caused by this 1 megawatt-hour of renewable energy, or 1 megawatt-hour savings of energy efficiency. The calculation of that can often be rather complex. In some cases, it can be a standard methodology based on resource, location, and potentially time of day, and a couple other parameters, and that will actually allow the calculation to be automated and automatically imprinted on the certificate as soon as it's issued. To the extent the methodology is a little bit different than that and more bespoke by each project, it may be something that's added to the certificate information at a later time. In any case, it certainly can be tracked along with this certificate. Emissions attributes and the interaction between those and regional power markets is an emerging area where we've done a lot of work with the various tracking systems we work with to enable the tagging of power market, of power source and sink. So where did this power actually come from? There's some standards, I think, same in California, that focus a lot on where the source came from and if there actually was a transmission path from that neighboring state all the way into California. So we've tied in racks with E-tags, and basically you can match the two of those up in certain cases. That's something that may be needed, again, depending on how the regional structures and state programs set up for 111D. I mentioned earlier inter-registry import and export, so that's already been enabled, and that guarantees that there's no double counting attributes between regions. And again, so that's really something that can help facilitate these markets, and not a lot more work would have to be done in relation to 111D. There are, as I mentioned before, very large voluntary markets for renewable energy in the United States. And in the one region, or in the two regions where you have cap and trade programs, that's California, and then the REGI market in the Northeast, eastern part of the United States, there is an adjustment process that allows the voluntary contributions to emission reductions to be counted separately from the cap. It's called the off-the-top mechanism, and that's supported by the information that's in the tracking system. So again, in this case, it just tracking systems help support the existence of voluntary markets alongside cap and trade compliance markets. Finally, public reports always help and provide transparency to these kind of markets. So just now highlight on some of the elements. We can certainly discuss these in more detail as we get to the question session, but I want to delve into basically take a look at what are some of the different options that states have or on how the markets can be structured. So if we look at the first model here, which is essentially the first line of the table, this would be a simple approach. The compliance will be put on the emitting generators and there's no RPS in the market, and it's just it's a mass-based target for each of the generators. So that, as an example, could be a cap-and-trade program. So in that sense, it's just allowance trading is all that happens in that market. There's no impact of renewable energy, energy efficiency, certainly not directly in that market, and everything is pretty simple. If we then move down a step and say, well, we want it to be a simple approach to implement, but also and we still want the compliance to be on the generating unit, but we want there to be a role for energy efficiency and renewable energy reductions to the extent the market supports it. So in this case, what this would mean is that the emitting generators would have to comply with an emissions rate limit, so a pounds per megawatt hour limit, and if they could not comply with that, then they would have the ability to buy reductions produced by renewable energy and energy efficiency. So there's still no RPS in this market, but that's a way where that could take place. And I have the next slide will go into a little bit more detail on that. Then the next couple of models, basically going if you have more of a portfolio approach where you both have an RPS and a cap and trade, or an RPS and emission rate limit. And then finally, if you, instead of looking at compliance on the generator level, you look at a compliance on the utility level. Those are the last two examples. So delving into a bit of detail on starting with scenario 2 and 4, where essentially we have rate-based targets. And the example I put in here is that you have a generator. Their target, and I'm just using Alaska for an example here, the target in Alaska is 1,003 pounds per megawatt hour. The actual emissions from this generator were 7.5 million pounds. They generated 5,000 megawatt hours. That gives us an average of 1,500 pounds per megawatt hour. So this is obviously above the target. Well, in this example, then what they do is they say they'll buy RECs from a facility. And now, again, there's a, what does a facility mean? Alaska would have to decide on which kind of facilities will count and so forth. But Alaska being in a fairly isolated power market, it's very likely they would say it has to be Alaska renewable energy generator or non-emitting generator. So if the generator buys 2,500 RECs, then essentially what one model under this is that you just add this to the calculation under the numerator in that the 2,500 RECs, or the 2,500 megawatt hours, do not have any emissions. So you still have 7.5 million pounds, but then it's divided by 5,000 plus 2,500 megawatt hours, and therefore you now get your 1,000 pounds per megawatt hours, and the generator has met the target. And in EPA's eyes, if this is what happens system-wide, then Alaska would have met this because the emissions would have gone down, at least on a mass basis. Now, these RECs would have been used by the generator and therefore would not have been eligible for an RPS market or any voluntary market in other states. And as we discussed before, the null power still flows into the local power market and so forth. But that's an example of how a rate-based target can work with that. Now, if there was an RPS market, if there was an RPS in Alaska in this case, then the renewable generators would essentially have a choice. They could either sell their RECs to the generators that need to comply with the rate target, or they could sell it to the utilities, the lower serving entities that would have to comply with RPS. So there'll be two markets for them, and the RECs could flow to one or the other market. That's one example of how it could work. If we take a look at a mass-based target and an RPS instead, and then we can think of the two different ways that you can have a mass-based target. So if we look at the left-hand box first, we basically have a reduction target. Essentially, the state will say, emissions have to be reduced by 30% compared to what they are at the baseline year. So the generator, they have emissions of 10,000 pounds. The limit is 10 million pounds. The limit is 7 million. If they buy 2,000 RECs, in this example, the RECs have an attribute of a 1,500 pound reduction per megawatt hour generated, then 2,000 megawatt hours times 1,500 pounds gives you 3 million pounds, and that's essentially 3 million pounds reduced from that renewable energy generation, and then they meet the limit of 7 million, basically the 10 million minus the 3 million. So that's one way where they're buying the emission reduction from the renewable energy, and therefore that renewable energy, those RECs are not eligible for RPS or voluntary markets. Now there's a question here. So you have RECs. Are these actually RECs they're buying, or would they be buying these denominated somehow in tons? And either way would work, and it doesn't necessarily complicate how the tracking system works, whether you keep the REC as the tradable unit with an emission attribute associated with it, or if somehow you convert it by retiring the REC and then issuing, as an example, 1 ton units of reductions instead. But that's on the reduction target policy. So another example of a mass-based target would be a cap and trade policy. So the same, when I look in the right-hand box, the generator still emits 10 million pounds. They buy ounces to cover 7 million, and then they buy 2,000 RECs to cover the last 3 million. And that way they basically, have bought either reductions from renewable energy, or they bought allowances to cover their full emissions. The last option here is maybe a bit more controversial, at least whether this is even an option under Section 111D. I'm still including it, and I think at least it's an illustrative example. But this is the idea of essentially putting the compliance target on the load, the entities selling power to the retail market rather than the generators. So in this case, this is where, as an example, an all-generation tracking system becomes critical to support this market. So if we walk through this example, it's a low serving entity, or EDU, in the parlance of 111D. It has a target of 873 pounds per megawatt hour. This is an example from Minnesota, and they sell a total of 10 million megawatt hours. They have, if we look at the left-hand box, this is their portfolio of certificates at a given point in time, and compared to their sales. So again, they had. And it looks like I left a couple of zeros out. I added a couple of zeros. So essentially, the total sales up here should read 10,000 instead for this example. But so they have certificates that match the sales. In this case, they have 10,000 certificates to match the total sales of 10,000 megawatt hours. The emissions liability for each of these certificates is different. Coal is higher than natural gas, is higher than nuclear. And then finally, as I mentioned before, the part that they did not have certificates for was 3,500, so then they are assigned the residual mix certificates, which are, in this case, have an emissions rate of 1,000 pounds per megawatt hour. So if you add these up, that gives you emissions of 11,100 and emissions rate of 1110 pounds per megawatt hour. Now, what they then, one of the ways that they can then try to comply with the target, again, this is the 1110 pounds per megawatt hour is obviously above the rate, the target of 873, is that they buy wind certificates, so RECs essentially, that have a 0 emissions per megawatt hour. And then if you then do the calculation again, you'll get to an emission rate of 860 tons per megawatt hour. And in that way, they basically, the attractiveness of doing it this way is that it takes some of the complexity away of the physical power flows, because you're relying on the certificates that a given utility or load serving entity had at the end of the day, the reporting period, quarterly, annual, and so forth. The challenge obviously is how does that then cause some issues on the physical side of the power section, or how do those transfers actually happen? But in this case, you don't need to do as much, a lot of gymnastics about trying to figure out where power was generated and so forth, because you basically have a certificate that specifies this, and you have a market that will value these certificates in response to the emissions rates, and then the utilities and load serving entities will basically manage towards that. Now, in this example, if you then have an RPS market, these RECs, these 2,500 wind certificates, would then also be counted towards the RPS compliance that the utility would have to meet. And then I think this is a critical point, because this would not, at least in our eyes, and I think there's general agreement on this, but if not, please ask the question in our discussion, would not constitute double counting, because essentially a state would tell a utility you have to do a certain minimum of renewable energy, and you have to comply with 111D. So they're going to buy a minimum amount of RECs, but if for some reason they want to buy more RECs, because it helps them comply with Section 111D, that's fine. But if they bought the number of racks that they were required to, those still could count as zero emissions per megawatt hour for their 111D compliance. I think this maybe generates some discussion as well, Paul. But again, this is an example of how you can do it with an all-generation tracking system and put in the compliance on the utilities. There's some indications that EPA, at least in the way they set the baselines, did not allow for this possibility, but certainly I think it's worth considering. So I walked through a couple different scenarios for how this could work. One of the issues that continually comes up, and again, this is an issue that APX will be looking into a little bit further, is the interstate trading issues. Specifically, if you have one state using mass-based, another one using rate-based target, and so forth. But you know, some of the options that we've at least temporarily identified is, you know, what if you could structure regional programs for 111D that correspond to the power region boundaries? You know, that's one option. This obviously would make some of the accounting and the tracking of the power market transactions easier. However, it has significant disadvantages in the fact that a lot of states are carved up between different power pools. And how do you then handle it when a state is participating, as an example, in both MISO and SPP, or you know, has their own still regulated market, and then maybe also participate in the PJM interconnection? So it's not that easy just because of the maps we looked at earlier to actually define what is the right region. And the EPA, for some of their modeling, even used a different definition of what a region constitutes. You could, for interstate, just be, you know, some of the interstate issues, you could essentially kind of assume your way out of them, where you could say, well, you're going to have GHG restrictions, greenhouse gas restrictions implemented across all states because everybody have to comply with Section 111D. Well, that does not necessarily reflect I mean, and that, you know, so that's one option to essentially kind of ignore some of those issues, and therefore you wouldn't have to worry so much about the physical power flows, because again, you know, everybody has to comply. So even if I'm buying power from another state, and that's from a coal plant, I know that those coal plant emissions are handled in that state because they have to comply with 111D. Even if I don't account for them as an importer. There is, though, the very real risk, I think it is a very real potential, that states will implement rules on varying timetables. And also, as we looked at in the table before, states do have different requirements that they have to meet. An example of, you know, a state that had to deal with this today, where there's not equal greenhouse gas restrictions across states, is California. Right, so California had to come up with a process of how to account for imports of emitting power from neighboring states, and they have done so. And the question is, will other states have to do that as part of Section 111D, or can they just say, well, now the neighboring states also have restrictions, so we don't have to account for that? Maybe there's a way to track inter-region transactions, so we can basically somehow delve into some of the information that is within power pools on how physical power transfers happens. An example now that Reggie has been looking at for a while has to do with the states of Maryland, Delaware, District of Columbia, which all are part of an interconnection, PJM interconnection, where the majority of the states are not a part of the cap and trade program. So Maryland, Delaware, and DC are part of Reggie, and they get power from across the PJM interconnection region, but how can they actually account for, even know where that power is coming from when it's within a power pool as opposed to being delivered from one power pool to another? And there are some ways to potentially get to more of that information, but nothing that's really apparent already right now. Finally, you know, the options we went through on the previous slides around all generation tracking, they resolve a lot of the issues associated with interstate trading of power, because again, all the emission liabilities will be accounted for on the sales side. Again, you have an issue of states participating in more than one power region, and then also, as mentioned, the EPA may have indicated that's not an option under their rules. So to end up, there's certainly a lot of complexities associated with Section 111D, and specifically the rules that have been set out by the U.S. EPA, whether it's around renewable portfolio standards, cap and trade, regional power markets, you know, just various stages of electricity regulation across different states, energy efficiency, and then renewable attribute markets, power attribute markets. I think it's important to point out that, at least as far as we can tell, every single state in the United States, with the possible exception of Hawaii, are involved in cross-state rec markets. So it's not just the states that have a renewable portfolio standard. There are several states that are supplying rec markets, either compliance or voluntary, even if they don't have their own renewable portfolio standard. So, and I think that's the realization of that is also why EPA is putting some emphasis on figuring out how to handle RECs and those emission attributes. We talked about power regions. The question of indirect versus direct emissions, I didn't get into it too much today, but essentially the idea of renewable energy and energy efficiency. Those are kind of indirect emission reductions versus direct emissions at a smokestack. The accounting has to be right to make sure that there's no double counting across that. As Warren mentioned, this presentation is based on a paper. Here's a link to it. Anybody have any questions? Obviously, we'll open it up for discussion now. Hopefully some have come in already. You're always welcome to send me an email or give me a phone call. I think everybody can benefit from discussing this more and get smart on how 111D actually will work or potentially could work. So with that, I'll stop it right there. And thanks for your attention, and look forward to the questions.
Hey, Lars, thank you very much. You've covered a lot of ground and given people a lot of information on a quite complicated topic. Not surprisingly, we've gotten a bunch of questions, and I want to start with some that just ask you to clarify a few of the scenarios you were talking about. If we could go back to scenario 3 for a second.
Okay.
Go back a few slides.
I think I need to control back.
Do you have control, or does Samantha?
I think Samantha does. Samantha, if you want to go back.
Good, perfect. So in that scenario, why would the 2,000 RECs be multiplied by 1,500 pounds per megawatt hour?
Yeah, I didn't go into too much detail on this, so very good question. So in this case, I just assumed that that's based on the methodology that this state or region had chosen, that was the outcome, that basically it was determined that every REC reduced emissions by 1,500 pounds by backing down other resources. Now, is that the right number? Don't know, right? And there's a lot of complexity, and there's a lot of, EPA does spend a decent amount of time on this in the rule again. But, you can replace the number by 500. It doesn't really make a difference in the example. So if we assume that each REC reduces emissions by 1,500 pounds, then, if you bought 2,000 RECs, then you'll multiply 2,000 by the number 1,500, and that gives you the reduction.
Okay, great. Now if you go to the next scenario on the next slide, how do you have 3.5 thousand megawatt hours of null power from 3,000 pounds of coal, 2,000 pounds of gas, and the 1.5 thousand nukes?
Yeah.
So where the issue is, explain to people where you're getting that null power number.
Yeah. So yeah, so just to explain this a little bit more, the null power, again, I didn't go into the details of how this was calculated. I just said, okay, let's assume the residual mix attribute is 1,000 pounds per megawatt hour. So again, the way to the coal certificates, gas certificates, nuclear certificates are just what the load serving entity had already. That's in their portfolio. They did not have certificates for 3,500 megawatt hours. So then they were basically assigned the residual mix certificates, which had an emissions footprint of 1,000 pounds per megawatt hour from the full pool of all the certificates in this specific system, let's say NEPO GS, that were not claimed. So this residual mix was not based on what the utility had in their portfolio already, the coal, gas, and nuclear that I show in this box. It was based on the full tracking system residual mix. Did that clarify for you, Warren?
Yeah. No,
okay.
That's good.
Got it.
And also on this scenario, can you, somebody wrote in asking if you could explain again, under what circumstances would using a REC both for RPS compliance and for 111D compliance constitute double counting, and in what circumstances would it not count as double counting?
Well, I mean, essentially it comes down to how the state policy is set, right? But so if you think about it as state, if they say to utilities, you have to comply with 111D, you're the compliance entity, as opposed to the generator, and they also, have told the utility you have to comply with an RPS, either existing or a new RPS that will be implemented. Then, what the utility has to do is they have to buy certificates to meet the RPS percentage, so a number of RECs based on what their sales are, and then they have to calculate what their emissions rate is across their full portfolio. But that full portfolio will necessarily include the renewables that were used for the RPS. Now, so essentially what has to happen here is that the state has to, in their planning of how they're going to, on a state basis, meet the EPA 111D goal, they can't say, we're going to get emission reductions from RPS, and then we're going to get emissions reductions from the utility meeting the emission rate. Because essentially the RPS reductions will be included in how the utility will meet the reduction. Now, that just means that, if the state is targeting a certain reduction, they have to think about that, and they can't say that those 111D and the RPS are two separate tools to meet the 111D. It's essentially one combined tool, and they have to set the targets in terms of the 111D emission rate accordingly.
Good. Okay. Well, that explains it to me. We'll see if somebody still has questions about that, they could write in. Let me ask a couple of more general, broader questions, and then we'll come back to some of these very specifics on 111D compliance that folks have written about. One, if you could talk about some of the cases where energy efficiency certificates are being tracked, how that's being done or where.
Yeah, so specifically in Connecticut, I believe, and there's a energy efficiency or similar programs of basically of load reduction or programs that can create certificates in NEPA GIS. In North Carolina, you have utilities have energy efficiency programs that go through a commission process and eventually results in energy efficiency certificates being issued in NC-RETs and then used towards compliance with that state's. And I believe actually the RPS in North Carolina is called the Renewable Energy and Energy Portfolio Standard, Energy Efficiency Portfolio Standard for that reason. And in the case of the North American Renewables Registry, there were a couple of voluntary projects related to some data centers that were undertaken that created energy efficiency certificates. Those who targeted the voluntary market, and I think the voluntary market for energy efficiency certificates has not really grown as some folks expected at a certain point. But the short of it is that for each of those tracking systems, functionality was built into track energy efficiency certificates, and it's not that separate from RECs. The main difference is instead of for RECs, where generally you can look at a meter and see how much was generated, for energy efficiency you need to have a protocol, measuring approach, and verification process to make sure that the savings were actually achieved.
Okay. And here's another sort of general question about the workings of tracking systems and RPSs. How many RPSs allow unbundled RECs? I mean, basically, RECs without any geographic restrictions on where they come from.
Yeah. So unbundled RECs, I think close to every program allows it, but in terms of unbundled from another state or even from a national, that's a different story. And I think national sourcing, sometimes if you really read between the lines, you understand the policy, you can figure out if it's national or not. But clearly the ones that are most often mentioned are North Carolina, where a portion of the compliance can be from facilities from any state. Missouri is another example. I believe Kansas, for the years, they don't allow RECs in all years, but for the years they allow RECs, I believe that can be nationally sourced. There may be a couple additional ones that I'm forgetting about, but certainly those are some of the ones that we've seen.
Okay. And one person writes in, and I believe the answer is going to be no, and the question, but you can answer this. Has the EPA finalized 111D acceptance of the use of RECs for compliance even when the generation is located in one state and the REC is used in the RPS of another? What are the implications when one state is using a rate-based approach and the other a mass-based compliance approach?
Yeah, and yes, nothing has been finalized, right? I think the comment deadline was earlier this month. So EPA has received all the comments through the comment process. I believe it's more than 1 million comments, and they have a deadline of a final rule next summer, June 1, I believe it is. But so nothing is final. Certainly from what's in the draft and then some subsequent information that the EPA sent out as well, there were a lot of questions about this issue and multi-state interactions and so forth. And I don't think anything is final. And to be honest, it's something we look into as well, specifically what about if different states do that. In my mind, it seems to be that there should be a way of setting up the accounting so it works, but I haven't necessarily figured out exactly how to do it. Yeah.
Okay. Here's a couple of long questions around scenario 3, and I have some more questions about scenario 3 after, so we may want to go back to that slide. In this scenario, you assume that the EGUs can purchase RECs to lower their mass. Where mass-based targets are used, this already reflects any emissions displaced avoided by renewable energy among EGUs in the state. If these states and EGUs are permitted to reduce, adjust the mass further for RECs already affecting the mass, that's double counting. So are you saying that mass-based states should be permitted to purchase out-of-state RECs or RECs that are not affecting the mass already to adjust the mass further? And how could you ensure that only RECs that have not already been counted are used to adjust the rate?
It's a very good question, right? And I think one of the things that will be key is to count how the attribution of renewable energy to today there's an accounting of who is in terms of the account holder in the tracking system that retires the renewable energy certificate or the energy efficiency certificate for that matter. And I think there'll likely be a role for tracking systems to add and for which state are these attributes counted in terms of whether it's a reduction proposal or whether it's as a zero. But the idea would be if you look at these emissions, if you look at it from a market perspective, would be that the generator has a certain amount of emissions, and if they're not reducing their emissions necessarily, but they still have to meet the target. So what they're doing instead is they're paying a renewable generator to generate more energy and reduce emissions on the system as a whole, and they get to claim it, right? And there's a difference between the generator meeting the limit set by their state and the state meeting the limit set by the EPA, right? So the state has to comply with the EPA. The state has to implement policies that manages to comply with the EPA. So if they say that we need a policy, we're going to set a policy where generators have to meet this limit, and if they can't meet it, then they have to buy energy efficiency, renewable energy savings. If that then means that allows, that, and then generators comply with that, then the generators get to count that, for their state compliance program, and the state gets to count that for their compliance with EPA. That's not necessarily double counting. That's essentially how the policy is set up. I hope that addressed the question.
Yeah, good. Here's related to that. Someone wrote in, if state X buys RECs from wind farm in state Y, that will create null power in state Y. Does that null power then take on the emissions associated with the residual mix in state X?
That is certainly what would happen under a all-generation tracking system, this scenario 5 and 6 that I went through earlier. It is currently what happens if you, as an example, if you're in the California cap and trade program, you are importing power normally from a wind facility in a neighboring state, but you're not buying the RECs. In that case, that imported power is assigned a emissions factor. So that is essentially what happens. So that is certainly one of the big issues is how would that be accounted for. So if you have the RECs imported to one state that has a RPS and they count them as zero emissions, then what happens in the state that maybe has a mass-based target and has renewable energy facilities and coal facilities, and generally if you have a mass-based target, you just choose to focus on the emitting resources. What about the attributes from that renewable energy? And that's one of the key questions.
Yeah. We have time for a couple more questions. I'm going to step back from these scenarios. We'll come back to them in a second. One person writes in, she asks, I heard that MRETS is working to allow imports of RECs from other systems. Can you provide more information on that?
Sure. Yes. So MRETS, in, I believe, month or 2 months ago, maybe 3 months ago, they the board made the decision to allow for imports to MRETS of RECs from NAR and MyRECs and NCRECs, I believe. I may be wrong with that. The MRETS website has updated information on that. I should know, but I believe those are the ones. Now, MRETS has been one of the states that allowed exports for several years. So they've certainly been part of the import-export for a long time. What you've seen in terms of the first systems that allowed for imports was that those were the Michigan system, the North Carolina system, then NAR supporting Missouri. And the reason for that was that Michigan needed to be able to import from neighboring tracking system as their RPS allows for the neighboring states under certain circumstances to supply RECs. North Carolina, as mentioned previously, they allowed for the national sourcing of RECs for some of that portfolio, and the same thing with Missouri. So those states needed the ability to import, and in response, several tracking systems, MRETS, Regis, and others allowed for the export of RECs from their systems. And MRETS has now also gone further to also allow for imports. I don't believe it's in effect yet. Basically, the technology has to be built out, but it's expected to be online in the first or second quarter of next year.
Good. So system power and regional power emissions are currently accounted for after the fact, always a year in arrears. Do you think it would be possible for more real-time accounting?
I assume the question in this case goes to the process in NEPOL GIS, in terms of the deadlines and the quarters that are in place for that, basically for trading quarters in that system. Generally, what happens now is that the information, so assuming that's the case, then the information that goes to NEPOL comes from the U.S. EPA. And there's a lag between when the emissions actually occurred until when the EPA has the information in hand, and then for us to import it into the tracking system. So I think, I certainly think there are ways to shorten or shorten that. There's also a question if a state sets up a program, how, there will have to be assumptions made in terms of how emissions are calculated or accounted for, what's the quality of data, and so forth, and there may be a focus on how can you then speed up this as well. I certainly think there are ways to do it, but there also are reasons for why there may be somewhat of a lag. And so what that means is, as an example, right, is that if you need to know what the emissions are of a certificate because you're going to be trading on the certificate attribute, then some of that trading may happen later. And to the extent there's a real-time connection between the physical and the certificates, then that's more of an issue than if the markets are separated.
Good. So I'm going to have one more question, but I first want to tell people on the line if I didn't get to your question, I'm sorry. If you want, you could email Lars. I'm sure he'd be happy to respond. My last question, Lars, is there anything you want to say to the group that you haven't had a chance to say up till now?
No, I think maybe the only thing I'll say is that this is incredibly complex. So, you know, we publish a paper, but it's very much somewhat of a working document. You know, at one point we thought we want to say, okay, at least this is what we're thinking based on you know, studying the rules and programs and so forth. As I said, so we're working on further, not necessarily further editions of this, but focusing on more specific issues related to 111D and specifically the multi-state issue on mass-based versus rate-based in neighboring states and so forth. So we, you know, I'll be happy to discuss this with anybody and certainly get input from anybody who's interested in discussing this further about what the potential options are, and also if you see something that we don't see.
Hey, great. Thanks so much for taking the time today. You've certainly have shown us how complex this is, but you've also illuminated the complexity and made things clearer, which is good. And so I'm sure a lot of folks will want to go read the paper. It's really good. And this webinar recording and the slides will be up on our website. We'll be back in touch with future webinars in the coming months. Thank you very much, everyone, and thank you, Lars.
Thank you, Warren.